Good morning, guys. It's Nick at Optum PS. Thank you once again for coming back to my channel. Welcome back. I am always over the moon to have you here, so thanks very much for all your support. As ever, if you like what I say today, please do like, subscribe, comment. The comments are the most important one, guys, because it really tells you what you want to know. I've had a few great comments back the last couple of days, which I'm very, very grateful for, and I'm going to try and act on one of those now. This is something I've actually avoided for a while. And it's the subject of automated market makers. But we're getting to that stage now where, let me say first of all, the reason I've avoided it for a while is no matter what we say or do on these videos, people will take the information and act upon it. And I'm going to start by saying a very, very strong disclaimer. I don't think you should use this yet. And I know that's crazy, and I know the guys that are more confident with this want people to use it more and more and more, because the more people use it, the bigger we get, the more comes onto the ledger, the bigger it works for XRP, Ripple, and the overall XRPL, and the better it is for all involved, because that should result in an increase in activity, an increase in usage, an increase in price on XRP. So it does make sense in the grand scheme of things for us all to use this. But in the same respect, that's in the grand scheme of things. My concerns right now are I don't like to use anything until I've seen it become very successful. Even in the traditional finance space, I don't recommend somebody uses a fund unless it's got the best part of $1 billion in, unless it's got the best part of 3 years active history with a good track record. I just don't. I'm Mr. Overcautious when it comes to things like that. And in the same respect with this, I've not seen it work. I've not seen it do exactly what it says on the tin enough to recommend anyone uses it. And as much as I'm going to say in this video, I don't recommend you use it, it is now time we all understood that this is something, because a lot of people are suddenly looking at their portfolios and going, hey, the bull run is starting. And the bull run is starting, right? Let's take a look at this week. Let's just jump on. You've got Bitcoin, okay, the last 24 hours, 1%, but 5% in the last week. But we've seen serious movement. Bitcoin's just shy of 66. It was 66 about 10 minutes ago. It's just below now. It'll probably be above before I finish this conversation. Ethereum was 2.7 this morning. It's just everything's dipped ever so slightly just recently. But if we take a look at the last 7 days movement, this is what's important. Shiba Inu, 45%, Wormhole, 43, Pepe, 40, Dog with Hat, 36. The altcoins are moving. Bitcoin's moving, the altcoins are moving, the whole market is moving. As ever, XRP straggled a little bit, which is, it makes me smile more than anything else now. I really don't care. I really don't care, because I know what's coming for this coin. But in the same respect, it's a little bit frustrating when people want to make money. I get that. But the markets are moving, and so people are starting to look at their portfolios and they're asking questions. People are saying things like, well, what do I do with my bag if I don't sell? Now, the answer to most people is you're probably better off selling. I don't intend to sell all my bag. That's my prerogative. I've got very different reasons for holding this. I'm in a different position, and we're all in different positions than everyone out there, aren't we? I have a different job than you. I've got different expenses. I've got 2 kids. You might have 3. Somebody else might have 1. I pay X my rent. Somebody else might pay Y. I've got some apartments I rent out. Somebody might have 100. Somebody might have none. We're all different. But in the same respect, there's different reasons we have, but people are starting to say, well, listen, if some of my bags move, I'm going to sell them. If some don't, then I'm going to keep hold of them. Or even if some do, I might keep hold of it. How can I monetize my crypto portfolio other than by selling at the top? And a couple of people have asked a question. I've raised the point about, I do believe that at some point the banks are all going to show up. I do believe they're going to be allowed to. You've all seen the SAP 121 thing. We know that they're currently struggling to find a way to custodize our crypto assets without majorly affecting the bank's profitability, really, is what it is. There's a different video I've done on that just recently if you want to dig it out and find it. But in the same respect, they are coming. BNY Mellon's now been given this special deal where they are allowed to custodize crypto assets. I don't know why. I don't know why they get special treatment, but they are. It's going to come to all banks. They're going to be able to custodize their assets. But I think what the banks will probably do is they'll say, well, listen, you get to keep the value of the asset. We borrow it like we borrow your fiat US dollars or your fiat pound sterling or euros. You put $100,000 into the bank and it's your money. We'll then utilize that money for our liquidity purposes or whatever way we see fit, really, within the realms of the law, and we'll pay you an interest for allowing us to borrow that money and utilize it. That's what the banks do, right? You get a crappy interest rate on your base account. I don't know what mine is, less than 1%, 0.01 or something like that. Not even worth bothering with. I get a couple of dollars here and there every year. But then you get a fixed deposit account, which is an option to put money in where they'll say, if you leave this money in for 3, 6, 9, 12 months, 24 months, 60 months, depending on the term, we'll give you X percentage in return. If you break it, then we won't pay you the interest, or we'll call our interest back, or actually this particular one, you can't break it, you must leave it in there for 12 months, so don't put more than you can afford in, that kind of thing. And normally they pay about, in recent times, between 3 and 4%. Just very recently now, the interest rate's gone up more like 5%. You could probably get for a 12-month tie-in. I do use them a little bit more so recently because they pay a bit more for some of my clients who need a bit more liquidity just in case they need to fall back on some money. I don't use them myself, but that's always been an option. And I think the banks will come up with something very similar where they say, yes, you lend me 1 Bitcoin and I will keep that Bitcoin in custody for you. So it's still your Bitcoin, but I will utilize that Bitcoin in whatever way I see fit. And I will pay you a rate of interest for using that Bitcoin. Now, I don't know if it would work well with Bitcoin. XRP is a better example, but I'm trying not to have total XRP bias on this channel. Some people pointed out that I talk an awful lot about XRP when most people have an interest in more than just one coin. But if it were XRP, for example, they might utilize your XRP to use it for transactions, for transacting money between one bank and another, or interbank from, their New York branch to their London branch, or whatever it might be. They may utilize your XRP for that, and they'll pay you a piece of their profits. And that's the one way I think is coming, but it's not here yet. So if this market goes berserk very, very quickly, and we find ourselves in a position where we do have a lot of money that we are able to monetize, then the banks might not be ready yet. SAP 121 in the US might be a problem. For other people around the world, there might be other banks in Europe and things that we can utilize. I can pretty much bank anywhere I like with some of the things I've got in place because I'm an international financial advisor. So I have interest in a lot of locations. I have bank accounts here, there, and everywhere. A few companies dotted around. So I get access to things that you might not have just as a normal, a normal whatever you do in life, whatever your job might be, in your home country, just with one bank account, or maybe 2 or 3 bank accounts as we have. But I have some extra things available, so I might be able to utilize something like that sooner than people in the US for certain. It's only the US that is suffering with the SAP 121 thing. But going back to it, right now we don't have that option. So I mentioned automated market makers, and a couple of people have asked me, well, what are they? And I've done the video for exactly that reason, because to be honest, I've never addressed this subject before. I've mentioned it. I've sometimes pointed people in the direction of other videos, but I've never addressed it because I don't want people rushing in and using this before they're ready, before it's ready. And they're 2 big points, by the way, guys, because it being ready is one thing. It proving its worth, it proving it's been successful for a long time is one thing, but you also being ready. I know that I personally am not. And that's because I haven't studied this enough. I haven't tested it with 10 XRP and $10 or whatever the test would be. I've not done any real work on this. So what I'm going to do to help explain it today, whilst offering the biggest warning I can that you shouldn't go anywhere near this until you personally have done all the due diligence and research that you need to do, I'm going to go straight to the horse's mouth. And this is Ripple's website, XRP, automated market makers explanation on their website. So you can all go and find this on the Ripple website as well, but I wanted to talk you through it, talking out a few comments as well. So automated market makers, what are they? AMMs. Automated market makers provide liquidity in the XRP ledger's decentralized exchange. Each AMM holds a pool of 2 assets. You can swap between the 2 assets at an exchange rate set by a formula. So you've got this example here. You've got the automated market maker, who's a robot in this case, US dollars on the left side, XRP on the right. And essentially, if you think a little bit like if you wanted to change your, whatever your home currency is, let's say US dollars, because you were taking a trip to Mexico and you needed Mexican peso, You would go into the bank or to a currency exchange firm or do it online. You would say, I have this much USD. You'd type in what you have, or you'd ask the lady what you have, and they'd give you an answer and say, that's worth this many pesos. And you go, okay. And you understand that they take a commission for brokering that transaction for you. Typically, the way it works in the world, the more you have, the better deal you get. If you've got $10 million, they'll give you a better rate of exchange and a lower spread to the bank than if you've got $10 or $100 or $1,000. That's just the way life works, and it works that way with everybody in the world. If you want $1 million mortgage, you get a lower rate than a guy who wants a $100,000 mortgage. That's just the way the world works. With the automated market maker, you're almost becoming that currency exchange company, be it the bank or the brokerage or Western Union, however you exchange your currency. You're almost doing that job. The difference is the AMM actually uses an algorithm to set the price so that we don't have to. There's no way I would know how many XRP you need to buy with your US dollars and sell to exchange for Mexican peso. Off the top of my head, I couldn't. I'm not sophisticated enough. I'm not knowledgeable enough. I'm not on the ball enough to know the answer to that. So the system does it all for you. So moving on, those who deposit assets into an AMM are called liquidity providers. In return, liquidity providers receive LP tokens, liquidity provider tokens, from the AMM. Liquidity provider tokens enable liquidity providers to redeem their LP tokens for a share of the assets in the AMM pool, including fees collected, vote to change the AMM fee settings, each vote weighted by how many LP tokens the voter holds, and bid some of their LP tokens to receive a temporary discount on the AMM trading fees. So essentially, an LP token is a receipt, isn't it? You're basically putting money in, they're giving you a receipt that says, we are holding this much of your asset. Here's the tokens you've got. That deems how much of a share of the pool you are entitled to, should you want to take it out, or should you want to vote, or should you want to do any of these things we've just talked about. So how the AMM works, an AMM holds two different assets. At most, one of these can be XRP, and one or both of them can be tokens. For any given pair of assets, there can be up to one AMM in the ledger. Anyone can create the AMM for an asset pair if it doesn't exist, or deposit to an AMM if it already exists. So, for example, if I wanted to do XRP and Ethereum, that would probably already exist right now, wouldn't it? Somebody out there would have beat me to it and set up an XRP and Ethereum one, so I would join that AMM so that I could use the two. When you want to trade in the decentralized exchange, your offers and cross-currency payments can automatically use AMMs to complete the trade. A single transaction might execute by matching offers, AMMs, or a mix of both, depending on what's cheaper. So again, in the example here, you've got someone turning up with their XRP, and there's an offer based on the dollar and the XRP price. The automated market maker gets involved with that. So note, you can determine if a payment or offer create transaction interacted with an AMM by checking for a Ripple state ledger in the transaction metadata. A flag's value of 167772216 indicates AMM liquidity was consumed. That went over my head. How about yours? Again, this is what I say. It's something you need to understand fully before you get involved in this. An AMM sets its exchange rate based on the balance of assets in the pool. When you trade against an AMM, the exchange rate adjusts based on how much your trade shifts the balance of assets the AMM holds. As its supply of one asset goes down, the price of that asset goes up, and as its supply of an asset goes up, the price of that asset goes down. That in itself is a stock market in its most basic form, isn't it? If I bring 15 potatoes to market, then the price of potatoes might go down in accordance with the laws of supply and demand than if I bring 2 potatoes to the market and there's people squabbling over my potatoes. That's just the way any market making system in the world works. The more you have of an asset, the more it affects the price. I used to go to a bar in Hong Kong that worked in exactly that way, right? So there would be a stock exchange, it was called a stock exchange, and there would be a stock tracking mechanism. So for every time somebody ordered a beer, the supply of beer went down, the price of beer went up. And then as beer went up, people would move away from beer and order a glass of wine or a whiskey and coke or whatever it might be, and that would drive the prices up and down. And you could see behind the bar what the price was, and you'd look for the bargains, right? You'd find, vodka and tonic's cheap right now, or whatever it might be. And it was a novel way of getting drunk, basically. It was a cool thing to do, but it's simple supply and demand. So that's how it works. An AMM Gives generally better exchange rate when it has a larger overall amounts in the pool. This is because any given trade causes a smaller shift in the balance of the AMM's assets. The more a trade unbalances the AMM supply of the two assets, the more extreme the exchange rate becomes. The AMM also charges a percentage trading fee on top of the exchange rate. Now, that's what's important to us to bear in mind in a moment. The XRP ledger implements a geometric mean AMM with a weight parameter of 0.5, so it functions like a constant product market maker. For a detailed explanation of constant product AMM formula and the economics of AMMs in general, see Chris Machowski's introduction to automated market makers. I'm not going to click on that link, guys. I'll let you do it in your own time. This is going to take more than a 20-minute video to get your heads around. It's going to take a lot of research and work. I recommend you jump onto the Ripple ledger, the Ripple website, and take a look at this in more detail. But going back to the point it made before, the AMM also charges a percentage trading fee on top of the exchange rate. So that's like when you exchange with your bank. The bank will tell you the base rate. Now the base rate or the flat exchange rate, let's say at the moment, right now, I mean, I can even do this, right? I'll jump onto, I'll go USD GBP. Yeah, so one United States dollar is 0.75 pounds sterling, which actually surprised me. I've not checked that recently. So annoying for me because I still think in pounds, but I get paid predominantly in US dollars, which means that the pounds in my bank are now worth more dollars, which is fine because they're in pounds, which is most of my wealth. But it means the dollars I was expecting to be paid this weekend or Monday morning are worth less in pounds to me now than they were on Friday. Yeah. Oh, yeah. So wow, it's 0.74 on Friday. They're worth more than Friday. Excellent. But they're worth less than when I last checked, which was probably a few weeks back. Yeah, I was thinking 0.77 still. So interesting. But going back to this, so token issuers. Tokens with different issuers are considered different assets. This means that there can be an AMM for two tokens with the same currency code but different issuers. For example, I'm going to say FOO, FOO, issued by Waygate is different to FOO, FOO, issued by StableFOO. Similarly, the tokens can have the same issuer but different currency codes. The trade direction doesn't matter. The AMM for FOO.Waygate to XRP is the same as the AMM for XRP to FOO.Waygate. Okay? Currency risk. When the flow of funds between the two assets in a pool is relatively active and balanced, the fees provide a source of passive income for liquidity providers. That's going back to those fees we saw before. So again, going back to your bank, the bank will charge you the flat rate plus a spread, which is normally 1% or something. So there it was 0.75. The bank might say, we'll give you 0.73 US dollars to the pound if you want to switch. So that's where they make their money, and that's where this fee works on this respect as well in a very, very basic form. However, when the relative price between the assets shifts, liquidity providers can take a loss on the currency risk. So that's important to know. So there is a chance that you will lose money using this system. Now, the longer it goes, the more it's in play, the more we understand it. I imagine it will be a case where 1 or 2 days a year you might lose money, but predominantly the fees outweigh whatever you might lose on the bad days, and we all make a bunch of money. That's how this is going to become popular, how it's going to drive liquidity into the XRPL. This has to work in a way that we become profitable or no one will use it. Restrictions on assets. To prevent misuse, some restrictions apply to the assets used in an AMM. Take a look through that. I mean, the asset must not be an LP token from another AMM. The asset is a token whose issue is authorized trust lines. The creator of the AMM must be authorized to hold those tokens. Only authorized trust lines can deposit that token. That's where it gets a little bit more complicated. And if the clawback amendment is enabled, the issuer of the token must not have enabled the ability to claw back their tokens, which makes sense as well, doesn't it? LP tokens. Whoever creates the AMM becomes the first liquidity provider and receives LP tokens that represent 100% ownership of assets in the AMM's pool. They can redeem some or all of those tokens to withdraw assets from the pool in proportion to the amounts currently there. The proportions shift over time as people trade against the AMM. The AMM does not charge a fee when withdrawing both assets. Okay, now good to know. For example, if you created an AMM with 5 ETH and 5 US dollars, then someone exchanged 1.26 USD for 1 ETH. I'm assuming this is a old explanation with those prices, but they exchanged 1.26 USD for 1 ETH. The pool now has 4 ETH and 6.26 US dollars in it. You can spend half your LP tokens to withdraw 2 ETH and 3.13 US dollars. So in that case, what you're looking at is a situation where, because some have been utilized, it reduces what you can take out. So there are reasons you need to be very, very cautious that you know exactly what you're doing before you get involved in this. Looking at the example there, 5 USDC in and 5 ETH in. Somebody uses it to take out 1.26 US dollars for 1 ETH, which means that there's now 6.26 US dollars in the AMM and 4 ETH left in the AMM. And there's 50 LPT tokens, which means 50% LPT, you can get half of each out. Anyone can deposit assets to an existing AMM. When they do, they receive new LP tokens based on how much they deposited. The amount that a liquidity provider can withdraw from an AMM is based on the proportion of the AMM's LP tokens they hold compared to the total number of LP tokens outstanding. LP tokens are like other tokens in the XRP ledger. You can use them in many types of payment or trade them in the decentralized exchange. To receive LP tokens as payment, you must set up a trust line with a non-zero limit with the AMM account as the issuer. However, you can only send LP tokens directly to the AMM, brackets redeeming them, using the AMM withdraw transaction type, not through other types of payments. Similarly, you can only send assets to the AMM's pool through the AMM deposit transaction type. The AMM is designed so that an AMM's asset pool is empty if and only if the AMM has no outstanding LP tokens. This situation can only occur as a result of an AMM withdrawal transaction, and when it does, the AMM is automatically deleted. So again, pretty damn complicated, guys. If you sit down with somebody who knows exactly what they're talking about, it's a lot more straightforward than this comes across. I have sat down with an expert who's explained it in more detail to me, but it's quite complicated for now, isn't it? You need to understand this before you get involved. There are many, many traps, minefields that you might stumble into that result in a loss of either your fiat or your tokens, your coins, whatever it is you decided to use here. This is not for us yet, and I'll explain that when we get to the end. So just to carry on, LP token currency codes. LP tokens use a special type of currency code in the 160-bit hexadecimal non-standard format. These codes have the first 8 bits EX03. The remainder of the code is SH512 hash truncated to the first 152 bits of the two assets. Currency codes and their issuers. The assets are placed in a canonical order with a numerically lower currency and issuer pair first. As a result, the LP tokens for a given asset pair's AMM have a predictable, consistent currency code. I may as well have been speaking Chinese there for myself. I don't know if you guys are a lot more tech savvy than me. I can't code. I don't know anything about this. I just about managed to do a YouTube video and send myself an email. This part is not for me. There will be a day when this part happens without me needing to know anything about it, and that's when I will get involved. Trading fees. So this is the bit that's important to us. Trading fees are a source of passive income from liquidity providers. They offset the currency risk of letting others trade against the pool's assets. Trading fees are paid to the AMM, not directly to the liquidity providers. Liquidity providers benefit because they can redeem their LP tokens for a percentage of the AMM pool. So again, the LP token is that receipt you've got. A little bit like holding a, if I buy a couple of shares in Apple, I'm given a stock receipt. All right, it's digital now, but still the same thing. I'm given a digital receipt to say I own them shares, and if ever I want a piece of the profits, I show my receipt and I'm given my dividends from Apple. Or if I want to cash them in for the capital growth, I pop my receipt back in and I'm given my profits and my investment back, right? That's how most investment things work. It's similar. Liquidity providers can vote to set the fee from 0 to 1% in increments of 0.001%. Liquidity providers have an incentive to set trading fees at an appropriate rate. If fees are too high, traders will use order books to get a better rate instead. If fees are too low, liquidity providers don't get any benefit for contributing to the pool. So I imagine what will happen there is each pool will you sit down with the liquidity providers, you decide on what is an acceptable amount to charge. In the early days, probably more because there's fewer transactions. It might be 1%, it might be 0.5, something like that. As time goes on and billions and trillions are going through these things, then of course 0.001% might make you an awful lot of money anyway. If there's thousands, millions transactions going through all the time, it might be 0.001% of an awful lot of money. So the amount doesn't bother me in the grand scheme of things. In the early days, it's going to be higher. In the early days, I'm not going to touch it for the barge pole. So each AMM gives its liquidity providers the power to vote on its fees in proportion to the number of LP tokens they hold. So if I've got 10 tokens and you've got 20 tokens, you get 20 votes and I get 10 votes. If there's 100 votes altogether, your votes are worth 20% of the decision, mine are worth 10% of the decision. Easy to understand. To vote, a liquidity provider sends an AMM vote transaction whenever anyone places a new vote. The AMM calculates its fee to be an average of the latest votes, weighted by how many LP tokens those voters hold up. Up to 8 liquidity providers' votes can be counted this way. If more liquidity providers try to vote, then only the top 8 votes by most LP tokens held are counted. Even though liquidity providers' share of LP tokens can shift rapidly for many reasons, such as trading those tokens using offers, the trading fees are only recalculated when someone places a new vote, even if that vote is not one of the top 8. Get it? Kind of. It makes sense, doesn't it? The top guys make the decisions, basically. I don't think there's ever going to be a day when I'm in those top 8 unless it's my own liquidity pool I've just started, which I definitely won't, because I've already said I'm not touching this until I've seen it become successful. Auction slot, again, the Ledger's AMM design includes an auction slot. A liquidity provider can bid LP tokens to claim the auction slot to receive a discount on the trading fee for a 24-hour period. The LP tokens that were bid are returned to the AMM. When the AMM, with any AMM, when the price of its assets shifts significantly in external markets, traders can use arbitrage to profit off the AMM. That can result in a loss for liquidity providers. The auction mechanism is intended to return more of that value to liquidity providers and more quickly bring the AMM's prices back into balance with external markets. No more than one account can hold the auction slot at a time, but as a successful bidder, you can name up to 4 additional accounts to receive the discount. Guys, it gets complicated, doesn't it? It's probably too complicated for a video. I'm already 27 minutes in. Representation in the ledger, an AMM entry describing the automated market making itself. In the ledger's state data, an AMM consists of multiple ledger entries. So one is the AMM entry, one is a special account root entry, and trust lines. Deletion, so you can basically delete them. This is something that becomes very, very complicated, which is why I've not really gone into it in any detail. I hope it's brought a little clarity to you. It probably hasn't brought a lot because even I haven't done enough research on this to be able to really do it. What I'll probably do is spend some time and come back with an AMM for Dummies type video. That's what I prefer. I like the simple explanations of how they work. I think that will be further down the line when I've come to a point that I've used this myself and I'm experienced with it myself, and I can give you a very simple explanation of how it works. I won't be using this until I've seen it prove itself. And I know I'm sat there with all my XRP currently earning me 0, including capital gain at the moment because they don't go up very much. But I would rather earn 0 knowing that what I hold is absolutely safe than make mistakes because I'm inexperienced and I'm doing something I don't understand yet. A little bit like when I say don't day trade unless you know how to day trade. Don't use an AMM unless you know how to use an AMM. Research it, do all the due diligence you can if you want to use this, and then I strongly, strongly suggest if ever you wanted to go ahead with it, you do it with a tiny amount. A tiny amount of your XRP and any other coin, a tiny amount of your XRP and fiat, whatever it might be that you decide to test the water with this, you are dipping your teeniest pinky toe in the teeniest, slightest, shallowest piece of AMM puddle you can find. I don't think this is ready yet. Some of the guys that are using this will hate me for saying this because they want us all to be using this because the more we use it, the bigger it gets, the more money everyone makes. I get it. I'm not ready for this yet, and I don't think most of you guys are either. The other side is when I say that I think that the banks will pay us an interest like a fixed deposit for using our coin, I strongly suspect they will use it in something like this. So I think, for example, let's use JP Morgan Bank. JP Morgan might open an automated market maker fixed deposit account, and they say to you, so-and-so, whatever your name might be, you give us 10,000 XRP and 10,000 US dollars. We will place it into an account and we'll give you X% return. Or they might say, give us 10,000 XRP, we'll give you this return. Slightly lower, of course. They might turn around and say, we expect to make between 10 and 20%, and we'll give you 50% of our profits on your coin. I have no idea how they're going to do it. It's too early in the day. But I strongly suspect if this becomes popular, there will be a way of utilizing the AMM without taking all the risk yourself by exchanging a piece of the profits with a big institution like a bank who can afford to employ the world's greatest technical minds to make sure this goes right. They'll probably do it. You know, I imagine Ripple will offer something at some point where Ripple turn around and say, here's one of our partner companies. They will offer custodization services to place your money in the AMM and create profits for you without you having to do it yourself. But of course, we charge this fee. We expect that piece of the pie. It might be that the AMMs make 20%, they pay us 7 or 8%. I don't know how it will work, but I would be more comfortable doing it that way, exchanging all of the risk for a piece of the profits, just like I do with my cash. Cash in the bank is exactly the same. It doesn't sit there in a bank account with our name on it. The banks do whatever the hell they like with it. They probably ledge it 1,000 times, leverage 1,000 times and stick it out in credit card debt or mortgage debt, or they buy investments in weird and wonderful countries and stocks and shares that we would never dream of buying. They do whatever banks do. You know, I don't need to go into that. I've worked for banks before, and nobody knows every last bit of what they do. But what banks do is they utilize our assets, they take risk with our assets, and they offer a level of protection for using that. And that's how it will work with this. I'm waiting for that day because I don't need to be making profits on this right now. People have asked about things like staking. I don't think there's going to be a way to stake your XRP. I think this will be the way to make it work. Perhaps some of the exchanges will park your XRP off the exchange into an AMM and will pay you a dividend much alike staking. Perhaps that's the way it will go. I don't know. We're still very early, guys. We're really, really early in this. I mean, I'm not touching this thing with a barge pole. Until I've seen billions of dollars go through it successfully, I'm not touching it. That probably makes me overly cautious, but that's me. So I hope that helps, and I hope it's more about telling you where my mindset is as opposed to what the system is, because I know I didn't explain it very well. I read it off the market maker webpage because I don't know an awful lot more about it than that. I will do some more work on it. I'll do some experimentation with it. What I'll have a look for some other guys' videos out there, and I'll pop in the comments if I see any really good explanations of it, because it's something we all need to know exists, and we need to know it's coming. For me personally, it's something I will use in a passive way. I will allow an institution that I trust to utilize the AMM and pay me a piece of the profits in exchange for them taking on all the risk, just like I do with my money in a bank account. I hope that helps, guys. As I say, if you like what I said today, please do drop me a like, subscribe to the channel. Please do ask me as many questions as you can in the comment section. I really do like the questions. It actually does me some favors with the YouTube algorithm as well. I think YouTube picks up the more people that comment and ask questions, the more the video gets shared around. So that does me a whole bunch of favors as well. So I really do appreciate all your help, guys. I appreciate you sticking with me for 33 minutes on this one. It's been longer than normal, so thank you very much for your patience. And I hope I brought a little bit more clarity to the situation, even if the clarity was don't touch it yet, like me. Anyway, guys, thanks very much. It's Saturday afternoon. I'm off to a barbecue. Have a great weekend, and we'll speak soon. All the best, Nick.